Hello, my name is Jeremy from your International Business Channel. Today, Repatriating Profits Made Abroad, a guide for you SME owners. For SME enterprises, international expansion offers an exciting opportunities for growth, new markets, and to increase revenue. But alongside these benefits comes the complexity of managing profits generated in foreign markets. Repatriating these profits, bringing the money earned abroad back to your home country, can be a challenging process with legal, financial, and operational hurdles to navigate. The good news? I've yet to come across a country where it is not possible for you to send money home. So here's a guide to help you understand the process and to make informed decisions. Well, why repatriate profits at all? While having money available at home allows you flexibility on how it's used. You may want to expand further into other overseas markets. You may want to pay out dividends to your backers. Maybe you want to pay down debt. Money sitting in a bank account in your host country is not doing you a lot of good. Bring it home. So what are some of the key considerations before repatriating profits? Firstly, of course, understand local regulations. Many countries have strict rules governing on how businesses can transfer profits abroad. Some impose foreign exchange controls that limit or delay currency transfers. Research your host country's regulations to ensure compliance and avoid penalties. Partnering with a local tax expert, such as a legal advisor or accountant, can sometimes help navigate these complexities. Choose the right repatriation method. Businesses have several options for repatriating profits, including dividends. It is probably the most common method where profits are distributed to the parent company as dividends. This often requires the local entity to declare and pay taxes on the profits before transferring them. Royalty or licensing fees. If you own intellectual property, you can charge the foreign subsidiary royalties or licensing fees, which may be subject to lower taxes in some jurisdictions. Management fees. Charging the subsidiary for management or administration services is another option, but this method must be substantiated with proper documentation to satisfy their tax authorities. Loans or debt repayment. Your subsidiary can repay loans or debts to the parent company through interest payments, though interest payments may be subject to withholding taxes. And don't forget, as we've talked about in the past, thick and thin capitalization. Double taxation. This is a concern in many countries of being taxed in both the host and home countries. It's a common concern for SMEs. Fortunately, many countries have bilateral tax treaties to prevent these. These tax treaties often reduce withholding taxes on dividends, royalties, and interest payments, making it easier to transfer profits. Check the specifics of the tax treaties between your home and host countries to identify any tax relief or exemptions that may be available. Note there are some surprising exceptions. For example, there is no double taxation agreement between Singapore and the United States. Monitored currency exchange risks. Currency fluctuations can significantly impact the value of repatriated profits. For instance, transferring funds when your host currency is weak relative to your home country can lead to substantial losses. Optimize for tax efficiency. Work with a tax advisor to structure your repatriation strategy to maximize efficiencies. Strategies may include reinvesting profits locally to benefit from deferred tax liabilities, or setting up a holding company in a low-tax jurisdiction to act as an intermediary for profit transfers. So some practical steps for repatriating profits. Firstly, evaluate your financial position before initiating any transfers. Assess your business's financial needs both locally and abroad. Ensure the foreign subsidiary retains enough capital to meet operational requirements. Consult professionals. International tax laws and requirements are complex, and the consequences of non-compliance can be severe. 3. Document everything. Tax authorities often scrutinize profit repatriation transactions. Maintain detailed records, including contracts, invoices, transfer justifications, to substantiate your actions and ensure transparency. Use digital tools. Modern financial platforms and tools can simplify the process of managing international payments. Consider using fintech solutions for cost-effective and efficient currency exchanges and transfers. Some of the common pitfalls you should avoid. 1. Avoiding local tax obligations or overlooking local tax obligations. Failure to pay local taxes on profits before transferring them can result in significant fines and legal complications. Ignoring transfer pricing rules. Transactions between your domestic and foreign entities must comply with transfer pricing regulations to ensure that the prices are set at arm's length. Again, non-compliance can attract penalties and increase scrutiny. Rushing the process. Hasty profit transfers without a clear strategy can lead to unnecessary tax burdens or financial losses. Take the time to evaluate all options and align them with your business goals. And understand your host country's rules. China only allows one transfer per year. So to conclude, repatriating your profits is a vital yet complex aspect of running an international business. By understanding the regulations, optimizing your strategy, and seeking professional advice, SME owners can streamline the process and maximize the value of their overseas earnings. With careful planning, your international profits can fuel business growth both at home and abroad. If you've enjoyed this brief video, please like and subscribe. As always, I wish you fair winds and following seas on your international journey. Do take care.